Hello, my name is Manal Magdi, and in today's session we are going to have a final revision regarding accounting for SMEs course. In today's session, it is subdivided into two main sections. First, we are going to have some exercises on accounting for SMEs, how financial accounting differs for SMEs, whether it follows GAAP or IFRS. We're going to see different treatments and different situations. Second part or second section in this revision, we're going to have some exercise on financial on how to perform financial analysis. We're going to perform horizontal, vertical, and the financial ratio analysis. Let's start by section 1. Here in example number 1, we have got here a company which is an SME, and at the end of 2019 they have reported the following numbers. As we can see here, the company had land, building, just a moment please, land, building, equipment, inventory, accounts receivable, cash, and goodwill. Okay, and the historical cost for the company at the end of December 2019 were as follows, and then there were fair value. So we had here historical cost and we had here fair value. Okay, so what are you required? According to GAAP, ABC should report total assets at December 31, 2019 in its balance sheet as follows. If we refer back to the rule regarding historical cost, we will remember that historical cost for GAAP, it only takes into consideration the historical cost in its records, except for marketable securities, and none of these items or none of these accounts is marketable securities. So here we can apply the historical cost over all of these accounts. So regarding exercise, then we have to make the summation of 10,000 for the land, and so we're going to use historical cost for all of these accounts. And there is no marketable securities. Okay, so we're going to add the 10,000 plus the 20,000 plus the 12,000 plus 10,000 plus 10,000 plus 15,000 for cash and 30,000 for goodwill. So the summation would be 107,000. So the choice would be none of these. Okay, and if we're going to apply IFRS, okay, if we refer back to the rules regarding fair value revaluations, we find that IFRS allows revaluing its asset from historical cost to fair value. These items were inventory, property, plant and equipment, intangible assets, investment in marketable securities. So here we have got here land and building, equipment, inventory. All of these are items that can be revalued to fair value. Okay, accounts receivable and cash, we're not going to revalue them. Okay, so the land increased to 11,000, so we make fair value revaluations, and buildings increased to 25,000, equipment decreased to 10,000, inventory decreased to 8,000. So, and the rest we are going to calculate it based on, let's answer it. So IFRS, we have revised our rule, so we're going to take the fair value for land, 11,000, plus 25,000 for building, plus 10,000 for equipment, plus 8,000 for inventory, plus 10,000 accounts receivable plus 15,000 cash. They are not from the items that apply fair value revaluations, okay? And goodwill 30,000. Okay, the summation is 109,000. So the choice is number D. Okay, number D. Okay, so we finished exercise number 1. Exercise number 2. Exercise number 2. Here we have a company, ABC company. It is an SME, and at the end of 2019, the records show the following information. We've got here FIFO, LIFO, and average. If the company calculated its assets or its total assets according to FIFO and LIFO and weighted average. If it is FIFO, the amount would be 12,000, and if it is LIFO, it would be 11,000, and weighted average it would be in between, just 10,000. If the company, in number 1, if the company follows the gap, ABC should report ending inventory in its balance sheet as, if we refer back to our rules, for accounting for inventory, we will remember that GAAP applies FIFO, LIFO, and weighted average. However, IFRS applies only FIFO and weighted average and specific identification. And also here for GAAP, it applies specific identification. However, LIFO is not applied under IFRS. It is not permitted. So if we answer it, if we follow GAAP, then we can apply FIFO. So if we follow GAAP, we can apply FIFO, LIFO, and weighted average. So the 3 numbers are allowed. So we have to find them in our choices. We've got here 12,000, which is FIFO, 11,000, which is the LIFO, and 10,000, which is the weighted average. So it can be any of these. So the choice is D. And regarding question B, if the company decides to apply IFRS, then the ending inventory would be reported in the balance sheet as. So if we refer back again to our rules, IFRS, it applies FIFO and weighted average only, and LIFO is not permitted. So it can be only 12,000 or 10,000. So 12 or 11,000, this is incorrect. 12,000 or 10,000, that is correct. And 11,000 or 10, it includes LIFO, so it is incorrect. It can be any of these or none of these, so our choice is number B. Okay. Let's continue. We're going to continue here. Exercise 3. We have got here an SME, ABC company. It's a firm established mid-December 2019. Its main activity that it engages in is photo frames trading activity. During the following dates, a number of frames has been purchased in a ready-to-sell condition. During the last third of January 31, 2020, 150 frames were sold. So that is an important part of information. Let's see. The number of frames that the firm has made or in its inventory and reported in its inventory on December 31, 2019, it had 200 frames and the cost per unit were 25. And on January 16, 2020, it made 150 frames for 30 LE per unit. That is the cost, okay? So the total number of units in its inventory is 350 units. The following information related to the market has been available on February 29, 2020. It had a market cost or replacement cost, for 20 LE, the selling price, the selling price for 25 per LE per unit, and it had cost to complete sales equals to 4 LE per unit. So let's just sum it up here. The market value for the units equals to 20 LE per unit, and the unit selling price equals to 25 LE per unit, and we have got here cost to complete sales equals to 4 LE per unit. Okay, the required. First, we are required to calculate the value of inventory reported on the balance sheet on December 31, assuming that ABC Company Management refuses to apply both weighted average and specific identification. So, regarding number 1, the inventory identification methods or inventory valuation methods includes FIFO and LIFO, right? So if we and it refuses to apply weighted average and specific identification, so we're not going to use them. So the remaining methods are FIFO method. How to use FIFO method? FIFO method, it means first in, first out. And in point number 3, he's asking if by the end of March 2020, the market value increased from 20 LE per unit to 30 LE per unit, and the naturalizable value increased from 4,200 to 5,000. Determine the implication on inventory valuation in the balance sheet dated March 31st, 2020. First, we should understand or should differentiate between using market value and naturalizable value. Market value is used under GAAP, and naturalizable value is used only under IFRS, where you can make inventory evaluation to market value under GAAP, while naturalizable value is used under IFRS. So first, we've got here market value increased from 20 LE to 30 LE. So and previously let's answer it here. Question or point number 3 here, we're going to answer under GAAP and under IFRS. If the market value was 20 LE per unit and the total number of ending inventory were 200, so it was 4,000 LE, and then it increased to 30 LE per unit, and there are 200 units, so the total amount would be 6,000. So the total amount of increase in the market value equals to 2,000. And if we revise again the rules of GAAP, we will remember that the reversal of write down when there is an increase is not allowed. So there is no journal entry and no inventory reverse. Okay, while under IFRS we can see that the naturalizable value increased from 4,200 to 5,000. This is the amount which we mentioned before. It increased from 4,200 to 5,000, and if we remember, the rules, the reversal of write down is allowed under IFRS, so we'll answer it here. The previous net realizable value was equal to 4,200 and the current net realizable value equals to 5,000. So the total amount of increase equals to 800. So the journal entry would be inventory and and 800. So we're going to increase the inventory by 800 and decrease inventory write down by 800, and the inventory cost at March 31st equals to 5,000 LE. Let's continue. In exercise number 4, ABC's unadjusted trial balance at December 31, 2019 shows that development costs equals to 200,000 and other data shows that accrued development costs equals to 100,000. So first we should remember an important piece of information is that accrued development costs can be added to current development costs since accrued accounting basis is accepted under both IFRS and GAAP. This is the first piece of information. Secondly, is that development cost or research and development in general under GAAP there is no such kind of a specific category, so it is expensed in the income statement, while under IFRS there is a specific account for development costs, so it is reported in the balance sheet. Okay, so according to GAAP, ABC should report development costs, so it's going to be expensed directly and there is no specific account for it, so it will be expensed in the income statement and it would be equal to 300,000. So choice for question A. Okay, under GAAP is that development cost would be equal to the summation of the 200,000 plus the 100,000, so the total would be equal to 300,000. And since there is no specific category for research and development R&D, so it will be expensed in the income statement, so the choice would be the income statement equal to 300,000. While under choice number B, under IFRS there is a specific category for R&D, so we will add also the 200,000 plus the 100,000, so the total summation would be 300,000 and it would be included in the balance sheet, and the choice would be C, it would be in the balance sheet, equals to 300,000. So the only difference is the accounting treatment or how they are going to be categorized. The GAAP would treat it as an expense, while IFRS would treat it as a specific category for R&D. So if we go back to our slides in the previous session, we can revise here the point of difference between GAAP and IFRS in terms of how they treat intangible assets such as research and development. Development costs are expensed as incurred, with the exception of internally development software that can be used externally. This is just an exception. So development cost is expensed as it incurred, while internal costs to create intangible assets such as development costs are capitalized. That is what we meant. And capitalization means that it is going to be reported in the balance sheet as a part of the capital. Where, if we remember, in the last session, here, investment property. Under GAAP, there is no such separate category for investment property, while under IFRS, there is a specific category for this kind of property, plant, and equipment that are bought for investment purposes, such as to acquire rent, or for capital appreciation, where they buy a certain kind of an asset at a lower cost, and they wait for it to increase its price in the future in order to sell it at a higher price and then gain that difference. So investment property is initially measured at cost and can be subsequently revalued to market value. So if we apply this kind of rules, we should, if we are applying IFRS, so we're going to look for which items that are bought for investment purposes. So office building, it is an asset. Building to earn a rental income, so this can be an investment property. And land for capital appreciation, so it's the same category. While office building, it is an asset. Trucks, it is also from the property, plant, and equipment, it is an asset. And a warehouse for storage, so there is no purpose, there is no intention to use it in investment, for investment purposes. So we have to differentiate between GAAP and IFRS. There is no such category for this, no investment property, and they are expensed directly, while under IFRS, or they are considered property and plant and equipment in general, there is a specific category for this. So the questions here, in question number 5, ABC reports investment property under GAAP. There is no such category, so investment property doesn't exist, so it is none of these. And in question number 6, ABC reports investment property under IFRS. It would be, yes, there is a specific category for this, so we're going to add the building to earn rental income, building for rental income equals to 2,000 plus the land for capital appreciation for 1,500. So the total investment property in this case would be 3,500 LE. So if we refer back to our choices, it would be choice number B. And in question number 7, ABC reports property, plant, and equipment under GAAP. It would be just the summation of them all in total. So under GAAP, property, plant, and equipment would be the summation of all of the given. Office building, plus the building to earn rental income, 2,000, plus 1,500 for the land for capital appreciation, and trucks for 1,500, and the warehouse for storage purposes 2,000. So the total summation would be 8,000 LE. Let's refer back to our choices. It would be choice number D. Last example, in order to make a quick review over how to record inventory and write down. Here we've got a company, it is an SME, and it is follows, you're asked once to apply GAAP and once to apply IFRS. So here in this example, we've got the historical cost at December 31, and the market replacement cost and selling cost, and the selling price and the cost to complete sales at the same date. Then it jumped forward to March 31, 2021, and giving you the same items and different figures. You're asked once to apply GAAP and once to apply IFRS. So if we're going to apply GAAP and IFRS, here we have got regarding write-downs. Under GAAP, we use the LCM, and IFRS also use the LCM. We choose the lowest cost method, but we compare between which two items? We compare between historical cost and the market value. Well, the IFRS we compare between historical cost and net realizable value. Okay, so let's apply. If we're going to apply GAAP, then we have to compare between at December 31, 2020. That is our question here. Sorry, it's written here wrong. Okay. And it's December 31, 2020. You're asked to apply GAAP, and you're asked about the value of ending inventory. So the value of ending inventory, we have got here the historical at December 31 is 8,000, and the market value is 6,000. So historical cost is lower, so we're going to choose market value, the LCM. So question number 1, the answer is B, the 6,000. You're choosing market value because you applied the LCM. It is lower than historical cost. If you're applying IFRS at the same date, December 31, 2020, we're going to compare between historical, which is 8,000. We have got it from here. Okay, 8,000. Net realizable value. The net realizable value is the difference between the selling price minus the cost to complete sales. So the net realizable value in this case would be the difference between 7,500 minus 500 equals to 7,000. So the net realizable in this case is 7,000, and historical cost is greater than it. So we're going to choose the net realizable value if we're going to apply the LCM. So question number 2, IFRS, the value of ending inventory would be, answer is C. If we're going to make a write down entry, sorry, here it is also wrong. Question number 3, according to GAAP, the write down entry, sorry, let's choose a different color. The write down entry and December 31, the write down refers to the amount of change or the amount of decrease, so the difference. Okay, so under GAAP, question number 3, the amount of decrease, okay, the amount of decrease, it decreased from 8,000, the historical cost. We have minus the market value, which is 6,000, so the difference is 2,000. So we're going to report it, the entry. We've got here the debit and we've got here the credit. We're going to record in the debit the write down by 2,000, and the inventory we're going to decrease it in the credit by 2,000. So the answer is choice number B. Okay, while according to GAAP, okay, he had jumped to March. If we're going to follow March, okay, let's write it here, March 31, 2021. We're going to compare between historical and market value. The historical remain the same because it is historical, okay? The historical cost, as we can see it here, 8,000, while the market value or the market replacement cost is 6,500. However, we have previously wrote it down here. The current cost, or the current cost right now, is 6,000. That is the amount that we are recording it according to it. So we can't make further, we can't make a reversal of a write down, okay? So we're going to compare like the current cost or the book value is 6,000 and the market value is 6,500. That is the current cost. We have previously wrote it down. So we can't make no reversal of write downs. The cost has increased right now and we can't make a reversal, can't increase a write down under GAAP. Okay, so if we go to GAAP here, to question number 4, the answer is the no write down entry. Here, no write down entry. Under IFRS, if we followed it March 31, okay, March 31, 2021, we're going to compare between, first we've got here the historical cost is 8,000 and the net realizable value at 31st of March 2021. We're going to here we're going to get the net realizable value for March 31. Okay, so 7,700 minus 200 equals to 7,500. And if we remember our current cost after write down, previous write down, it was 7,000. Here after write down also. It is here 7,000 and the net realizable value is 7,500. So reversal of write down under IFRS is allowed. We are going to increase the difference, increase by the difference here. We're going to calculate it. right now it is 7,500, the net realizable value, and the previous the current cost is 7,000, so it increased by 500. So the value of ending inventory would be the new net realizable value, okay, because it increased. So the value of net realizable value here is 7,500, while under IFRS the write down entry at December 31, he's referring to December 31, that is the one. So the write down entry, credit, it decreased by how much? It decreased from 8,000 decreased to 7,000, so it decreased by 1,000. Decreased by 1,000. So the write down here is 1,000, and inventory equals to 1,000. Okay, so the choice would be write down and inventory 1,000 because it decreased by 1,000. Okay, while on March 31st 2021 it increased by 500, so we're going to make the opposite entry. You're going to reverse it. Here you're going to write debit, credit, and you're going to increase the inventory 500, this amount, and write down 500. Why? Because reversal under IFRS is allowed. Why did we reverse it in this way? We're going to increase it by the 500. So inventory and write down because it increased by 500. Okay, and the reversal under IFRS is allowed, while if we refer back to GAAP, reversal is not allowed. So if there is an increase, we can't reverse back the write down. Okay, we're going to start by in this section the chapter 18, the financial statement analysis. According to our previous classes, financial statement analysis can be applied into three formats: either a horizontal analysis, or a vertical analysis, or financial ratios. All of this analysis helps us to understand where the company stands right now. So to better understand this, we can look further into this example. Here we've got a painter company, and these are the consolidated financial statements for painter company during the year 2020 and 2021 as presented, and you are required to prepare the horizontal analysis. Secondly, you are required to prepare the vertical analysis. Then you are asked to answer each of these ratios. So let's start. What is horizontal analysis? Horizontal analysis is that you compare the difference between this account between 2 years and write the amount of change or the percentage of change, whether this amount increased from year to year or it decreased from year to year. So for example, here we're going to start. You can apply, just notice that horizontal analysis can be applied to balance sheet, income statement, and returned earnings. As we can see here, horizontal analysis, it is a trend analysis, and it is a technique used to evaluate a series of financial statement data over a period of time. The purpose is to determine whether there is an increase or decrease in this specific account, and it is applied to both balance sheet, income statement, and statement of returned earnings. So let's continue. Here, for example, we're going to start by the assets accounts, okay, in this area. Here, first account we've got here, the cash. In year 2020 it was 64,200, and in year 2021 it decreased, equals to 14%. So a quick revise, how can we calculate the amount of increase? So for example, we'll start by the cash. How we're going to calculate the amount of change equals to the last year, year 2021 minus year 2020. So 60,100 minus 64,200. So the total amount equals to negative 4,100. If you would like to calculate it as a percentage, so you're going to divide the 4,100 divided by the year, last year, year 2020. Let me just write it here. You write the amount of change divided by the last year. So the amount of change divided by 2020, because you want to understand how much a percentage of increase from last year to this year, not the opposite. Okay, you're comparing this year to last year. So the amount of change was negative 4,100, and the total amount of cash in year 2020 was 64,200. So the total percentage of decrease was 6%. And we can, so the amount of increase here is 4,000. How much this amount of decrease represents, or the amount of decrease in percentage, it is equals to negative 6. The same thing we're going to apply the short-term investment. Here it is 50,000, and then in the year 2021 it increased to 96,000, so it increased by 19,000, and this 19,000 represents how much of an increase from the 50,000? It represents 38% increase from the 50,000. The accounts receivable, the net accounts receivable, in 2020 it was 102, and then it increased to 107, so it increased by 5,000, and this amount of change represents 5% increase from the 102,800. And then the inventory, it was 115,500, and it increased to 133,000, so it increased by 17,500, and this amount represents 15% of the 11,500. How do I calculate this percentage? I will show you after finishing the assets. Here the total current assets, it was 369,900, and it remained, just a moment please. As we can see here in the total current assets, there has been no change, because even if the accounts here decreased and increased, the amount of change, total change in the whole accounts, the total current assets, led to the same amount from year 2020 and 2021, which teaches you or shows you that you can make changes but you can maintain the same total current assets. Okay, so this is an important observation. This shows you how businesses work. Okay, so as you can see here, they maintain the same amount of total current assets from year to year, so it led to a zero amount of change in total current assets. However, the planned assets increased from 520,000 to 600,000, so it increased by 80,000. And if you divide this 80,000 by the 520,300, it will lead to a 15% of change. So the total amount of assets, it increased from 2020 to 2021 by 117,400, and this amount represents 14% of change, or 14% of increase. the accounts payable, if we're going to continue here, the accounts payable, we're first going to start by the current liabilities. The current liabilities here, it consists of accounts payable and income tax payable. And the accounts payable, they increased it from 145,400 to 160,000, so it increased by 14,600. So they have got receipts to pay or accounts payable to pay by 14,600, so which represents 10% increase in the accounts payable. And the income tax payable are still increased also by 1,500, and this amount of increase represents 4%. So the total current liabilities increased from 187,400 to 203,500, which is 16,100 total amount of increase. This amount represents 9%. The bonds payable, however, maintain the same amount, so there is zero amount of increase, which represents 0% increase or decrease. And the total liabilities, however, increased by 16,100, which represents 4%. And the common stock, it decreased by 20,000, so we're going to put here a negative or put it between two brackets. So the amount of decrease equals to negative 7%. So the common stock that we have in the stock equity decreased, so it decreased by 7%. And the retained earnings, it increased from 156,400 to 208,700, so the total amount increased equals to 121,300, and the total amount of increase equals to 73%. And lastly, the total stock equity increased also, so the total liabilities increased by 117,400. So the total amount, take another example to apply it. Here, for example, the total assets, how we can calculate it. You write, if you want it in amount, so you write here 2021 970,200 minus 85,200. So the amount of increase was 117,000. So the percentage of increase equals to the amount of change, 117,000, divided by the amount of cash or the amount of total assets in year 2020, so it equals to 85,200. So the total percentage of increase equals to 14%. Let's make another example here. Let's apply it to total returned earnings. Let's apply, because this is the biggest amount here. Returned earnings, if you would like to apply the total amount of increase or decrease, is it increased or increased? We just compare last year by this year. So this year we have acquired returned earnings by 286,700. That's last year. Here is the amount, 165,400. So the amount equals to 121,300, and the percentage of increase in this case, let's just write it here, the percentage is that you take the amount of change, the 121,300, divided by the amount of last year, in order to understand whether it increased from last year or decreased from last year. The total amount equals to 165,400. So it increased in total by 73%, which is a big amount, which means that the company has retained this big amount in order to finance its total assets. the 14%. So it majorly financed it from the retained earnings. Let's continue. Let us apply one last example. We can choose another account. Here let's choose the common stock. How can we calculate it? As follows. Common stock in year 2020 it was 300, and in year 2021 it was 280. So did it increase or increase from 2020 to 2021? So we're going to take the amount in 2021 and deduct from it the year 2020. In year 2021 it was 280,000 less the amount in year 2020. This is 2021, this is 2020, so less 300,000. So the total amount of increase or decrease, it decreased by $20,000. How much did this amount represent from year 2020? This amount of increase or decrease, the percentage of decrease, because it is a negative amount, equals to the amount of change divided by last year t minus 1, so multiplied by 100 in order to get a percentage. So the amount of change equals to $20,000, and the amount in year 2020 as follows, equals to 300 multiplied by 100, so the total percentage of decrease equals to 7%. So this means that common stock decreased by 7% this means that common stock decreased from $300,000 in year 2020. It decreased by 7%, so it reached in year 2021 equals to 280,000. Let's do the horizontal analysis for the income statement. So we're going to do the same thing for year 2020. Here we're going to calculate the amount, and we're going to calculate the percentage. So the net sales in year 2020, it was equal to 1,750,500, and it increased to 1,818,500. So the difference between year 2020 till 2021 equals to 68,000. So it increased by 68,000. This amount of increase represents 4%. So it increased from year 2020, it increased by 4% in order to achieve 1,818,500 in year 2021. For example, for net sales, the same way, either you calculate the amount or the percentage. The amount is calculated as follows: the current year T, which is 2021, okay, 1,818,500 less year T minus 1, which is year 2020. So the amount equals to 1,750,000. So the total amount of increase equals to 68,000, and this represents how much of an increase in percentage? 68,000 divided by year 2020, 1,750,000 multiplied by 100 equals to 4% an increase. Here the same thing for the cost of goods sold. It increased also. It increased by 15,000, and this amount of increase represents 2%. So if we deduct this amount of change from each other, we get a total increase in gross profit by 7%, and this amount equals to 52,500. If we deduct from gross profit the selling and administrative expense, it also increased from 479,000 to 499. So the total amount of increase equals to 20,000, and this amount of increase represents 4%. If we deduct from the gross profit the selling and administrative expense, we get a total income from operations equals to 32,500. This amount you can get it, this amount you can get it either way. You can get it from calculating the difference between these amounts, or you can calculate it from the difference of change between here and here. Okay, you can get it either way. Then the other there is no amount here. The other expenses and losses includes only one account, which is interest expense. The interest expense increased from 2020 from 14,000 till 18,000. So the difference equals to 4,000. This amount of increase represents 29% increase. The same thing if we deduct from the income from operations, if we deduct from it the interest expense, the 32,500 less the 4,000, you can get the total amount of increase here. Or you can deduct 290,000 less the 261,500 as follows. Less the amount of change in interest expense, 10,000, so you get a net income of 18,000. Sorry, this amount doesn't exist. So a quick revision: how did we calculate this amount? The thing that I want you to take into consideration is that in order to check that you are moving in the right direction or not, the amount of change, for example at gross profit, since it is a total, it should be the same. If you deduct the amount of change, the 68,000 less the 15,500, or you can calculate the amount of change from year T minus year T minus 1, the 807,000 less the 754,500. Both should give you the same amount of change, equals to 52,500. Why I mean gross profit specifically? Because it is a total. The same thing should apply for income from operations. The same thing should apply for income before income taxes, and the same for net income, because they are all totals. So this can help you to check if your results are correct or not. Like, let's apply it here for the net income. Either way should give you the same results. Either you deduct the amount of change here, 28,500 less the 10,000 should give you 18,500, and the change from year T to year from year 2020 till year 2021, 203,000 minus 184,500, it should give you the same result. I know it seems very obvious at this point, but this specific detail will help you later on when you study or when you apply vertical analysis. Just keep it in your mind for this time, okay? And lastly, as we have said before in the slides, that we can apply horizontal analysis on balance sheet, income statement, and statement of returned earnings. So we've got here the statement of returned earnings. The returned earnings on January 1, this is the first part, and then you add to it the net income, you get the total, and you deduct from it the total income, and then you deduct from it the dividends, you get the returned earnings at December 31. So that's calculated the same way. You calculate the difference between year T and year T minus 1. So year T is year 2021 and year T minus 1 is year 2020. So let's calculate the difference. It was 60,900 in year 2020 and it increased to 165,400. So it increased by 104,500, and the net income increased also by 10%. So the total amount, if you add both differences together, you get 123,000, and if you deduct from it the dividends, the amount of change, so you paid dividends, your payment for dividends increased only by 2%. So the total amount of returned earnings is as follows. So what we have been doing previously was that we were doing horizontal analysis, and your sole purpose is to determine whether there is an increase or decrease in the financial statement data over a specific period of time, and this is applied on the balance sheet, income statement, and statement of returned earnings. Let's continue to the second requirement. Analysis, it is a common size analysis. It is used to express whether each financial statement item as a percent of a base amount. Take into consideration that vertical analysis is applied to balance sheet and income statement. However, in the balance sheet, your the amount that you compare to is the total amount, or the total assets, the total base amount, while in the income statement the amount that you compare to is the net sales. We will see in our example what is meant by these two sentences. So step number 2, or required number 2, is that we're going to prepare vertical analysis, and it is applied to the balance sheet and income statement. So let's bring it forward. So here, for example, we are writing again the balance sheet for the company, and here is our year 2021, and here it is year 2020. You don't have to do it for both years. It depends on the requirement. But here in this problem, you were asked to perform the vertical analysis of both year 2021 and year 2020, as we see here. So it is a good practice for you. What we were talking previously is that vertical analysis, it is applied on the total amounts. So that is what I meant by on the total assets and the total liabilities. That is the total amount. What do I mean again? Is that you're going to compare how much this amount represents from the total assets, how much the total current assets represents from the total assets. How can we calculate it? The percentage for the total current assets in reference to the total assets is that you're going to divide and get the percentage. You're going to divide the total current assets. It is a ratio, 900 divided by the total amount of total assets, 970,200, and then you get the total amount of percent, which is 38%. So here it is 38%, and the total asset is our 100%. Okay, so this makes the planned assets, the difference between the 100 and the 38 equals to 62%, right? It is the remaining amount. So the total assets is subdivided into two ratios: 38% as current assets and 62% to planned assets. If you would like to compare it to the previous year, here the planned asset equals to 100%. This is for year 2021. If you would like to apply it to the previous year, you're going to do the same. 369,900 for year 2020. The total current assets divided by the total assets equals to 369,900 divided by 852,800 multiplied by 100. So the total amount equals to 43%. So 43% %. So in year 2020, the total assets was subdivided into 43% and 61% current assets, and here it is planned assets. So despite that the total current asset is the same from year to year, the company increased its investment in the planned assets, which caused an increase in the total current assets in year 2021. Let's continue in the same manner. However, in this ratio it is different. We were saying that we're going to compare totals. In the vertical analysis, you focus on the total, and the balance sheet, let's write in a different color. The balance sheet, it is subdivided into assets account and liabilities and stockholders equity or owners equity, right? Owners equity. So this is our total that we're comparing to. Here the total that we're going to compare to is the total amount of total liabilities and stockholders equity, while here we were comparing only to the total assets. Okay, so take care in this part. So where is our 100%? Our 100% is right here. 100%. Not only the total liabilities and not only the total stockholders equity. Actually, it is the summation of both of them that gives you the total liabilities. Okay, and the total liabilities and stockholders equity is equal to the total assets because it is the balance sheet. It is balanced. Okay, so when we are going to compare the amounts or make vertical analysis, we are going to divide these amounts by the 970,200 and not going to compare it to this. No, this is wrong. Okay, we're going to compare all of these accounts by the 970,000, all of them. Okay, so you get the idea. Let's start answering. So with regards to the total current liabilities here. Let's answer it. Total current liabilities divided by the total liabilities and stockholders equity or owners equity. So we're going to divide that 203,500 divided by the 970,200. You get actually here 20.9. so if you approximate it, you get 21%. If we apply it to the this is the total current liability, to the bond payable, okay, the bond payable divided by the total liabilities and owner's equity, you divide the 200,000 divided by the 970,200 multiplied by 100, you are going to get 20.6, which is approximately 21%, I mean, so 21%. So if you're going to calculate the total liabilities in the same manner, the total liabilities divided by the total, just a moment, total liabilities divided by the total liabilities and owner's equity, you're going to get 403,500 divided by the 970,200 multiplied by 100, you're going to get 42%. Or to be more specific, it is going to be 41.5. So if you approximate it, it would be 42%. 42%. Okay. Let's apply to the rest. The common stock divided by the total liabilities and owner's equity. So we're going to divide the 280,000 divided by the 970,200. We're going to get 29% approximately, and the returned earnings divided by the total liabilities and owner's equity. So 28,700 divided by 970,200, we're going to get 30%. And lastly, the total stockholders equity divided by the total liabilities and stockholders equity, 566,700 divided by 970,200 equals to 58%. 58%. So it is important here to understand that you have to, let's choose different color, this one, okay, is that the total liabilities and the total stockholders equity together form the 100%. And if you gather together the 21% plus 21 plus 29 plus 30, you're going to get the 100% also. While here in the total assets, it is direct the total current assets plus any other assets, any other non-current. While under the total liabilities and stockholders equity, it is the summation of those both two. Okay. Total liabilities and the total stockholders. Right here, it is direct. So let's apply it again to year 2020. Let's do it here just quickly. Just a moment, sorry. Let's do it here. So for year 2020, we can just take it quickly. The total liabilities with regards to the total liabilities and stockholders equity equals to this amount, 387,400 divided by the 852 100 equals to 45%. So this means that the ratio of the total stockholders equity with reference to the liabilities and stockholders equity would be the remaining amount. Sorry, it would be 55. 100% minus 45% equals to 55%. So this amount. So 55%, 45%. And the remaining, we can just calculate this 187,400 divided by the 852 to 800. It would be here 22%, and we have applied the 200 divided by the total liabilities and stockholders equity. It would be 23%. And with regards to the common stock and the returned earnings, %. And if we divide this 165,400 divided this 16%. Sorry, I meant 19%. As we can see here, if we refer back to the slides, you will see that vertical analysis, as we said, it is applied to the balance sheet and to the income statement, and you mainly divide each item on the balance sheet divided by the total asset in order to get the percentage. And if you're applying it to the balance sheet, and if you're applying it to the income statement, you divide each item on the income statement divided by the sales revenue, which we'll see next. So as we can see here, we've got here the income statement for the painter company, and as we have said before, we're going to divide all the items by the net sales. That's why it is you give them the 100%. So any amount will be just a percentage of the net sales, which means that you're going to divide the cost of goods sold divided by the net sales. So we have got here 1,011,500 divided by the 1,818,500 500. So we're going to get just a moment. 56%. 56%. And if it is for year 2020, this is for year 2021. For year 2020, we're going to divide 996,000 divided by 1,750,000. The total amount equals to 57%. So the cost of goods sold decreased by 1% from year 2000 in year 2021. The gross profit, divided by the net sales equals to 807 divided 1 500. You get 44%. And for year 2020, we're going to take this amount and divide it by the net sales. So 700. Sorry. 754. 500 divided by the net sales. Sorry. %. So 44%, 43%. Let's delete this. So the gross profit increased by 1% due to saving 1% in the cost of goods sold. And the selling and administrative, we're going to divide this by this and this by this. We're going to do it here. So selling and administrative divided by the net sales equals to 499 by 1,818,500 equals to 27%. However, for the previous year, 400 divided the net sales 1,750,000, the net sales of the corresponding year, okay, 27%. So despite that the amount changed, they have maintained the same percentage for the selling and administrative expenses. Let's apply for the income from operations. Income from operations divided by the net sales, 308,000, 1,818,500 equals to 17%, while previous year equals to 16%, 17%, 16%. And other expenses and losses, the only item that we have is interest expense. So interest expense divided by the net sales equals to 18,000, 1,818 equals to 1%, 1%, and previous year 14,000, 1,750 equals to 1% also. Income before income from taxes. Divided by the net sales equals to 290,000 divided by 1,818,500 equals to 16%, while in the previous year 261,500 equals to 15%, 16%, 15%. The last two items, let's continue here. Income after tax, income tax expense. Equals 87,000 divided by 1,818,500 equals to 5%, and the previous year equals to 77,000 divided by 1,750,000 equals to 4%, 5%, 4%. Lastly, the net income divided by the net sales equals to 203 divided by 1,818,500 equals to 11%. And with regards to the previous year, $184,500, 1,750. We're going to get the same percent, 11%. 11%. Horizontal analysis is different from the vertical analysis, is that you compare here between from year to year, while if you're doing vertical analysis you are comparing accounts, how much this account compares to the total. For the balance sheet you're comparing to the total assets, and for the income statement you're comparing to the net sales. Take into your consideration is that horizontal analysis, it is applied to the three statements: balance sheet, income statement, and the returned earnings, while the vertical analysis only applies to the balance sheet and to the income statement. And here you divide any account by the total assets, and here you divide by the total net sales. Okay, while here for the horizontal you compare year to year, year T minus year T minus 1. Lastly, we're going to compute the following ratios. Each of these ratios represent a specific, give you a hint about a specific point. Let's see here. Ratio analysis, it is as each one of them as a single ratio is not meaningful. The meaning that you get from it is that you compare it between the companies in the same industry. Okay. This table gives you a summary of the ratios that we are going to apply. The ratio analysis, or the ratios that we use in analysis, are subdivided into 3 categories. First, liquidity ratios, secondly, profitability ratios, and third, the solvency ratios. Let's start by the liquidity ratios. It has 4 types of ratios: the current ratio, asset test or quick ratio, and accounts receivable turnover, and inventory turnover. You have to understand and try to memorize the formulas for each of these ratios. These ratios are useful in order to understand whether the company is able to provide liquidity or to provide money in in a short period of time. That is the meaning of liquidity. So, for example, current ratios divide the current assets by the current liabilities, and this shows you the short-term debit paying ability. It's meant to measure the company's ability to pay its short-term obligations. Specifically, it shows you how it uses its current assets in order to fulfill its short-term liabilities. Here in this example, we are going to measure the liquidity ratios, the current ratio, as the accounts receivable turnover, and inventory turnover. So let's start answering each one of them one by one and understand the meaning of each of these ratios. Number 3, we're going to make ratio analysis. So if you are asked to perform liquidity analysis for liquidity ratios, it includes, number 1, the current ratio equal to the current assets divided by the current liabilities. In this case, $369, and the current liabilities so this is the amount equals to 1.82 times, which means that the company, as this amount increases, the higher the better. Okay, so we can interpret it as follows. If we make it as a ratio, the current assets in ratio to the current liabilities equals to 1.82 to 1. So it means that the current assets is 1.82 bigger than liabilities, which means, like, if you approximate it to 2% or 2 times, it means that the current assets is 2 times bigger than the current liabilities. So it can cover or it have this power, this amount of power to cover liabilities. It can fulfill its liabilities by 1.82. Okay, so the higher the better, and because it shows the company's ability to fulfill its short-term liabilities. Okay, the second ratio in the liquidity we're asked about here is the accounts receivable turnover. The accounts receivable turnover, it is equal to the net credit sales divided by the average net accounts receivable. So accounts receivable turnover, its equation is as follows: net credit sales divided by average net accounts receivable. It measures the liquidity of accounts receivable. What does it mean? It means that it measures the company's ability to collect its accounts receivable. That is meant by liquidating accounts receivable. How good or how efficient is it? Is the company in order to follow its creditors and collect from them these accounts receivable. As a result, higher accounts receivable turnover is the better. So let's turn over accounts receivable so credit sales of the same year of the net sales, which is given directly here, so this amount, and that just here average account receivable you get it by calculating the beginning accounts receivable plus the ending accounts receivable divided by 2. This is how you calculate it. So let's go back. Where is our net accounts receivable? It is in the balance sheet. So this is the ending accounts receivable, 107, 800 and 102. Which means that the company for each $1 of accounts receivable, it can pay it through net credit sales by 17.27 or it can achieve for each $1 of accounts receivable, it can achieve 17.27 net credit sales, which means that it has a power of $17.27 of net credit sales to cover for each $1 of accounts receivable. يعني لكل جنيه من accounts receivable هي تقدر توفر مبيعات ب 17.27 مبيعات على زي ما بيقول عنوتة يعني credit sales عشان to cover this accounts receivable. Okay, فلغاية دلوقتي up to this point all the liquidity ratios that we have achieved, the current ratio, the acidity test ratio and the accounts receivable ratio, the higher the better. Okay, so the next requirement is the inventory turnover. Number 4, inventory turnover. Let's see the equation for it. It is calculated through dividing cost of goods sold divided by average inventory. So we're going to find the number of cost of goods sold for year 2019, 2021, sorry, 1,000,000 and 11,500. So we're going to write it here, 1,011,500 divided by the average inventory, which is the beginning plus ending divided 2. So the beginning inventory, we can see it here, the 115,500 plus the ending 133 divided 2 equal. So the interpretation of this ratio, that higher inventory, the higher the inventory turnover, the better. Turnover means that the company's ability in order to like sell this goods, the inventory quickly, and like buy again and so on. So turnover means that it can not get rid, but like sell it easily and use it easily, and its turnover rate is high. So the higher turnover, the better. So let's sum up. Up to this point, we have finished all of the notice. Both are liquidity ratios, sorry. All of them, the higher the better. The higher the better. And as we can see that each one of them has got a meaning and has got its own interpretation, which is important for you to understand and like take a note, a side note for them. Let's continue to the next requirement. You are asked here we have finished the liquidity ratios. Secondly, we have got the profitability ratios. We have got first the profit margin. So let's start. Requirement number B. Profitability ratios. First, we've got profit margin, and as we can see here, profit margin equals to the net income divided by net sales. It measures how much of a net income can be generated for each $1 of net sales. الرول بتاعتنا في البروفيت مارجن the higher profit margin the better. يعني دايما interpretation بتاعنا احنا نمشيه ازاي؟ نمشيه بان احنا نقول for each $1 من الدومينيتور هيبقى يعني بيترجم ل كذا بوينتر هو التايمز اللي هيطلع لنا هنا الريزلت من النت انكم او اي حاجه في النومينيتور. خلينا نجرب مثلا في الاكزامبل ده profit margin هو net income divided by net sales. فين النت انكم؟ بنجيبه من ال income statement. sorry net income 203 and the net sales 1,815. So 203 net income divided by 1,818 500. So net sales. Okay, so our result equal to 0.11 times, which means that for each $1 من denominator ده is translated into a result من net income. يعني for each $1 of net sales equals to 0.11 of the net income. This result هو ده profit margin، يعني هو هامش الربح يعني. general rule انه the higher the better برضو. فهنا 0.11 هو يعني لسه قليل، بس يعني الفيوتشر بتاعنا in general results يعني كويس. فهنا for each $1 of net sales is translated into 0.11 of the net income. يعني the company can generate from each $1 of net sales $0.11 من net income. Okay, let's continue to the next ratio. Return on assets, ROA, equals to net income divided by average total sales. برضو بيقيس قد ايه total assets can generate net income، اما اللي قبليها كانت بتقيس قد ايه تعمل sales. دول two different numbers. برضو بيقيس شكل من اشكال profitability. واحد بيدور على السيلز بس، مبيعات بس، واحد بيدور على النت انكم بعد ما نشيل كل الاكسبنسز منه. ده رقم وده رقم. تمام. here equals to 203,000 divided by the average total sales. نقدر ناخده من هنا 852,800 plus 970,200 divided by 2. The result is equal to 0.22. Well, still this ratio, the higher the better. ده معناه ان for each $1 of total sales it can generate 0.22 of the net income, or $0.22 of net income. The next requirement is return on common stockholders' equity. Number 4. Number 4, return on stockholders' equity equals to net income divided by weighted average average stockholders equity. This ratio refers to how much of money or income that the investors or the stockholders get in return for their stockholders equity. Okay, let's see it here. The return on common stockholders equity equals to net income minus preferred dividends if it exists, divided by average common stockholders equity. If the preferred dividends doesn't exist, then just would be 0. It measures the profitability of owners' investment. Measures the net income that the owners can generate from the common equity that they have invested in the company. Let's see it here in the example. Preferred dividends if it exists. In this example, it is not present. So the net income equals to 203. There is no preferred dividends, as we can see here. It is not available. We have got only common stock. There is no preferred dividends, so this dividends is on common stock. Okay, so net income equals to 203,000 less 0 preferred dividends divided by average stockholders equity. As we have said before, average is beginning plus ending divided by 2. This is the amount that we are referring to, total stockholders equity, 465, 465,400 plus 566,700 divided by 2. The ratio equals to 0.39, which means that for each $1 invested in stockholders' equity, it can generate $0.39 of net income. So still this ratio, the higher the better, 0.39. The next requirement is earnings per share. Earnings per share, or EPS, equals to earnings per share equals to, just a moment, sorry. Earnings per share equals to net income minus preferred dividends divided by weighted average common shareholders shares outstanding. So at this point we are comparing to common share outstanding, not common shareholders equity, which is completely different. Just a moment. Minus preferred dividends divided by weighted average common shares outstanding. The net income, no preferred dividends, and the average common shares outstanding. Here we have got the common stock. This is the beginning, and this is the ending price, or the ending cost for common stock outstanding. And in order to get the number of the average common shares outstanding, you have to divide the cost of the common stock, the cost, divided by the par in order to get the number of shares. So, for example, the ending number of common stock outstanding equal to the 280,000 divided by the cost divided by the par value, $5 per share. So the total number of shares in this case, 56,000 shares, while the beginning number of common shares outstanding would be equal to the cost, the total cost, 300,000, divided by the par value for each share in order to get the number of shares, would be 60,000 shares. So in order to get the average of common shares outstanding would be equal to the sum of the beginning number plus the ending, the beginning 60,000 plus the ending 56,000 divided by 2, we get 58,000 weighted average number of common shares. So why we're doing this? In order to get the earning per share. So we divide by a number, like يعني رقم مش dollar value أو مش cost, divided by a number. So the average common shares outstanding equal 58 shares. Let's continue. So this is what we were calculating. The net income, we have got it here. The preferred dividends is equal to 0. The weighted average, which we were calculating, the beginning plus ending, the 60,000 plus the 56,000 divided by 2 equals to 58,000 shares. So the net income divided by the number of shares, we will get $3.5 earning per share. Per share. So because it is called earning per share. Okay, let's continue to the next part. Next requirement احنا كده خلصنا ال liquidity ratios اللي هما كانوا current ratio, asset test ratio, account receivable, inventory. liquidity يعني قيس قدرة الشركة انها توفر كاش بسرعة، يبقى عندها سيولة بسرعة. profitability انها to generate profit revenue، احنا مش بنتكلم انها تسجل حاجة، انها تبيع حاجة عندها، تجمع حاجة، لا، انها to generate revenue نتيجة الاكتيفيتي بتاعتها. اخر حاجة بقى اللي هي solvency، دول هما solvency ratios. Solvency ratios هي بتقيس the company's ability to survive over a long period of time، انها تقدر تستمر for a long term period in the future. تمام، هما two ratios اللي هو debit to assets و time interest rate. نقدر نقول انها يعني the other side of the coin. يعني مثلا لو coin ليها one face of it is liquidity, solvency is the other face of the coin. بمعنى انه لو liquidity هي بتركز اكتر على قدرة الشركة انها collect accounts receivable، يبقى معها liquid assets، انها تقدر to provide يعني liquidity او money بسهولة او cash يعني بسهولة. solvency هي من الناحية التانية، هي انها بتركز اكتر على ال debts بتاعتنا و debt paying ability. يعني لو ال liquidity بتركز على ان احنا نوفر كاش، فالsolvency بان احنا نوفر كاش internally للشركة، يبقى الsolvency الناحية التانية ان احنا نقدر نلبي ال debt paying obligations اللي علينا، ال debt obligations اللي علينا. فده من ناحية اللي هو الsolvency يبقى ده يبقى liquidity تركز على accounts receivable والحاجات دي اكتر، اما solvency تركز على ال debts وال accounts payable اكتر الناحية التانية. فهم two ratios, debt to asset ratio with times interest earned. However, at this point of time, you're not asked to calculate the times interest earned, so we're going to focus only on debit to assets ratio. Let's start it. أول واحد اللي هو debt to asset ratio بيقيس قد ايه في total liabilities قصاد ال total assets. يعني مفروض مثلا لو معايا total liabilities 1 يبقى مثلا قدامها total assets 1. لو زادت مثلا كل ما تزيد لا كل ما يبقى الوضع مش كويس، فيبقى the higher يبقى the lower the better. يعني كل ما نقلل liabilities دي هي obligations عليا، كل ما اقلل liabilities قصاد the ratio towards the assets كل ده ما يبقى احسن، فيبقى the lower the better. يبقى ده to asset ratio هنا the lower the better، ده ناخد بالنا منه. خلينا نحل بقى الاكزامبل بتاعنا. عايزين نحسب هنا اللي هو debt to assets. number C هنحسب solvency ratios. number 1 debt to assets ratio equals to total liabilities divided by total assets. Total liabilities for year 2021 نجيبها من هنا. Total liabilities 403 500 divided by total assets 970 to 100 multiplied by 100 equal 0.42. ده معنى انه for each $1 of total assets معانا equates to او قصاده 0.42 liabilities. ودي كده ريشيو كويسة، فيبقى the lower the better. كل ما يقل الريشيو دي كل ما يقل، يعني ده معناه ان انا معايا assets، يعني for each $1 of assets معايا 0.42 liabilities، يعني انا ما عنديش obligations كتير. اما لو بقى الريشيو بقت 2 او كده لا يبقى كده عالي، فيبقى كده 0.42 بالنسبة لي هنا كويس. ونضربها هنا by 100 عشان هي ratio زي payout ratio. لما نضربناها في 100 يبقى كده معانا 42%. ده معناها ان ال creditors have provided 42% من ال liabilities. فبالتالي كل ما بيقل الريشيو دي كل ما بيبقى more desirable بالنسبة لل creditors. ليه؟ لانه دلوقتي بيبقى لما بتقل الريشيو ده معناها ان الريشيو بتاعت الاسيتس بتزيد وان ال liabilities بتقل، وده بيبقى يعني better او بيبقى ال creditors بيحسوا ان في buffer، بيبقى شكل من اشكال الامان او safety بالنسبة لهم، علشان في more assets to cover for those liabilities يعني. بس فعشان كده ده السيفتي بالنسبة لنا. So a quick revision on how to interpret each of these ratios. Take into your consideration when you answer current ratio, you compare the ratio of current assets towards current liabilities. So we write it as follows: the ratio of current assets to current liabilities. As we can see here, it is 1.82, so we said that the ratio is 1.82 towards 1. يعني for each $1 of current liability it is met by 1.82 of current assets. أو another interpretation يعني أو بمعنى times، يعني for each 1 unit من ال current liabilities is met by 1.82 times أو 1.82 units من ال current assets. So for each 1 unit of current liabilities equals to 1.82 times of current assets. تمام. Turnover 17.6.27 times. You can answer it in this form. This means that for each $1 of average accounts receivable is met by 17.27 times of net credit sales. تمام. يعني for each $1 من accounts receivable بيساويه أو بيواجهه 17 مرة net credit sales to cover it. ده معناه accounts receivable turnover. And the same goes for inventory turnover. Can answer it in times, 8.16 times. Profitability ratios. Profit margin, here it is a percentage. Okay. So you multiply it by 100 and you get 11% profit margin. هامش الربح دايما احنا بنقوله بشكل percentage. 11% هامش ربح. margin a percentage return ال ROA percentage برضو فنضربه في 100 فنجيب كده يبقى equal 22%. return on stockholders equity هيبقى نفس الحكاية نضربه في 100 equal 39%. ال earnings per share لا بالدولارز يعني حتى لما declared في ال stock exchanges بنعرف ال earnings per share ال EPS in terms of dollars فده لا رقم in dollar amount فده take into your consideration. وهنا من الريشيوز اللي كانت the lower the better هي debt to asset ratio فدي كانت different عن الباقيين فدي حاجة لازم برضو ناخدها في بالنا واحنا بنعمل ratio analysis.